Okay, we know that there are the numerous investment options available to the investor. Okay, so he select the best options from the which of the investment options available to the investors. Okay, and that means by analyzing the risks and return associated with this different types of investment options, and on that basis we can say investor selects the portfolio. Okay, so the diversification of the funds into the different investments that reduces the risks. Okay, the loss of money in any particular you can say in a stream. Okay, we know that that particular stream in which we made the investment is not doing well. uh, we may have the losses in future. Okay, so from the business point of view, diversification of the funds, diversification of the investment into the different companies, into the different sector, different industries, different regions, that is important to minimize the risks. Okay, so that we understand in the last session, that is what is portfolio, what is diversifications. We also learn the two modern uh, portfolio theory, that is we can say the Markowitz portfolio selection model and the CAPM model, that is the capital asset pricing model. So we understand Markowitz first time he gives the idea of the risk and return associated with different investment options. Okay, he tells us that by analyzing the past years financial data of the organization, he calculate the standard deviation, he calculate the pattern of how that investment option gives the return to that particular investors from last we can say last few years, and on that basis he predict in future what will be the trends and pattern of return and the risks of that particular investment. Okay, so this is how the Markowitz we can say gives us the we can say the portfolio management theory. Another theory we understand, that is the CAPM, that is the capital asset pricing model. In that we see one formula. Okay, that is expected return is equal to RM plus beta in bracket RM minus RF. Okay, so with the help of this formula, we calculate the expected return on the risk, that is beta here is the risks we are taking while the investments. Okay, so this is how the two models we learn. Okay, so now in this chapter, that is in these sessions, we are going to uh, learn, that is the Sharpe, the single index model. So William Sharpe is the economist who studied the Markovitch model deeply, and what he found that whenever the investor has a huge fund, whenever he wants diverse investments. Okay, so at that point of time, okay, so it's a very complicated uh, procedure of the Markowitz, we can say, portfolio model. Because we know that in Markowitz portfolio model, we calculate the standard deviation, we correlate the risk and return for the each company. So in that situation, when we select the 100 companies, okay, so we can say it is not possible to correlate each and every company with each other. Okay, and that means from 100 companies, if I have the 100 options for the investments, then we need to correlate that 100 companies with each other. Okay, and then we find it out which companies gives the we can say the maximum return on the minimum risk. That means we compare the returns and the risk pattern of each company with each other. Okay, so it is not possible from the 100 companies to compare every company with every another company. Okay, so the process is lengthy. So what we can say the William Sharpe Finding out that whenever the number of investment options are large, it is not possible to apply the Markovich portfolio theory there. Okay, so how we can easily gets the optimum portfolio options, optimum investment options. Okay, so then we can say the Sharpe comes with this theory, and this theory is the single model theory. Okay, so single model theory actually uh, that gives us the relationship between the risk and return of the particular company without comparing with the hundreds of companies. So this is the we can say model given by the Sharpe, that is the single index model. We know that if you guys see you for any specific sector, we know that there are the different indices. We know that there are different types of indices in the share market. Okay, so what are those indexes? That is, we can say the as per the market. Okay, we know that the BSC, Sensex, Nifty, Nifty 50. Okay, we can say the Nifty mid cap, Nifty mid cap 200, Nifty mid cap 150, or mid cap 100. So these are the indices we made on the basis of the, we can say some of the sectors. Okay, we know that there are some sectoral indexes are there. Okay, that means for the manufacturing industry, there are some different index. For FMCG, there are some different index. Okay, so index means it is the combination of the number of companies we can say put together, and then we analyze the we can say the trends and pattern in that particular sector. So what we find it out, that is the trends and patterns in that particular industry look similar. That means the prices of the automobile industry goes up at the same time and goes down at the same time, because we know that that means that particular sector, that particular index behave in a same manner, because the product of the companies are same, the customer of the companies are same. So accordingly we can say the demand and supply for the particular product and industry services into the market are same. Okay, which having the impact of some macroeconomical factors like the inflation, employment rate, or we can say the per capita income. Okay, so when the per capita income is higher, then automatically the demand of the any particular goods or services into the market is higher. So automatically, what we found, that when the sales companies doing the good sales, automatically the revenue is higher. Automatically, the investor shows the confidence in the that company. So this pattern we can say apply for all the companies of the any specific sector. So that's we consider as the index. Okay, in we can say here is given in. So why we need the single index model? Why the Sharpe comes with this model? Because he studied the Markovitch theory, and what he found that the Markovitch portfolio theory uh, that established the fundamental framework for understanding the risk and return trade-off in investment portfolio. This work demonstrated that investor could achieve the optimal diversification by carefully selecting the securities with the different correlation pattern. But in Markovitch uh, portfolio theory, first we need to correlate each and every company with each other. So it is a very hectic and time consuming and lengthy process. So that's why Sharpe comes with the single index model. So that a Markowitz model requiring estimating the millions of covariance okay, for the large portfolio and overwhelming computational challenge. Okay, when we whenever we having the large investment options, okay, so the calculations and the mathematical part is a very large in the Markowitz portfolio management theory. So in single index theory, single index model theory, we reduce that mathematical calculations. Okay, we calculate the risk and return for the single index. That is mean the bunch of companies in the single index model. Okay, so mm, what is the market reality? Why we need the single model theory? That real world securities tend to move together during the market events. We know that some of the companies of the same sector, okay, moves in the we can say in the moves together. That means they moves on the upper side and the lower side at the same time, making the assumption of the negative correlation increasingly rare and the unrealistic. We rarely found that the companies of the same sector, we can say, uh, moving in opposite sides. Okay, okay, we always see the trends on a similar manner. Okay, when we found the negative correlation, if the one company is if there are fraud and corruptions in that organization, so in such a conditions we found only the negative correlations. Otherwise, if the all things are good in the organizations, so the companies moves in the same manner. Okay. Um, Okay, so what is another issue in the Markowitz portfolio theory? That the portfolio manager needed a simpler, we can say the more scalable model. That means that Markowitz the portfolio model theory is a very complex one. Okay, because we need to calculate the standard deviation and covariance of each security with another security, and it is a very hectic and the complex process. So that's why the William Sharpe come up with the single index model theory. Okay, so in 1963, William Sharpe introduced this a single model theory uh, for the simplification to portfolio theory that would earn him. So for this theory, that Sharpe also gets the Nobel Prize. Okay, so the single index model address the computational challenge for the Markowitz approach while maintaining the theoretical region. So in single index model, we considered all the type of companies of the same sector as the single index, and then we calculate the risk and the return. Okay, so the elegant simplification, that is the single index model, reduces the complexity. Okay, what the complexity, that is the calculation of the standard deviation and the correlations of each company with another company. That complexity is reduces in the single index model. Okay, single index market model eliminating the need for pairwise covariance and calculations. Okay, so the eliminating the need for pairwise covariance calculations. That means no need to compare each and every company with other company. Okay, for example, we take the 100 companies. Okay, so near about the 5,000 covariance or the standard deviations we need to calculate. Okay, and then we can choose the best companies out of that 100 companies. So it's a very hectic and the complex process. But in single index model, we consider that 100 companies as the single index, and then we do the calculations. So that's why that the calculations complexity will be reduces in the single index model. Okay, so uh, what are the practical implementations of the single index model? That is, instead of estimating the thousands of covariance, portfolio managers only needs the betas and the market variance. That is, beta is we called as the systematic risks, which is be seen in the economic conditions. The systematic risks, that means the risks is a out of control risks. We cannot minimize that risks as easily. For example, if some of the cases that is out of control of the investor, that is the natural calamities. Okay, the situations like the COVID-19, okay, inflation, recession, depressions. Okay, so all these are the conditions which is the out of control conditions. So the risks associated with such a type of microeconomical factors, or the we can say the natural calamities. or we can say the health crisis. So in such a conditions, that the risk associated with your investment is called as the systematic risk. Okay, so the portfolio manager only needs the beta, that is the systematic risk associated with the investment, with the investment, and then we can calculate the risks associated with the bunch of securities, that is the single index. We can say then why single index model is more we can say easy one as compared to the Markowitz portfolio theory. That is that single index model provides the practical portfolio optimization even with the thousands of securities. Okay, whenever we have the thousands of options, the single index model theory provides the solutions without the hectic mathematical calculations. Okay, making the institutional portfolio management feasible. Okay, so that's why the single index model is more preferable when the number of options of the investment is a large one. So in 1963, actually, in 1952, Markovitch used the theory, that is the Markovitch portfolio model. In 1963, after the 9 years of time, that William Sharpe used the single index model development. Okay, that publishes his groundbreaking single index model. Okay, so in 1964, actually, single index model is the base for the CAPM, that is the capital asset pricing model. Okay, in 1990, gets the Nobel Prize for his inventions. So the core equations of the single index model is here. If you see, this is the mathematical formula. The mathematical foundation of the Sharpe single index model can be expressed in one elegant equation that capture the relationship between the individual security returns and the market movement. Okay, so this is the formula for the single index model. That means for that 100 companies that we consider, for that 100 companies, we calculate only the 100 returns. Again, we no need to calculate the standard deviation of each company with another company. Here we calculate only the return of asset, that is the RIT, means the return of asset I at the time T. Okay, the dependent variable we are trying to explain and predict. Okay, so RIT is, we can say, the return of if you say we have the 100 companies. Okay, so if I want to calculate the 15 number companies return, so I write the R15T. Okay, if I want the return after the 5 years, then T is the time period. So RII means the name of the company, and T is the time period. It may be 5 years, 10 years. So what the returns I'll get after the that time period and for which company? So this is the return is equal to alpha I. Okay, alpha I means alpha is given is here the asset abnormal return, alpha this one specific expected return independent of the market movement. So that return is free from the market movement. Okay, it is, we can say, the risk free return, as we can say in the another form. It is the risk free return. That is the alpha I plus when we take the risk is a beta. Beta is, we know that it is a systematic risk. Okay, so beta coefficient measures the asset sensitivity to market return and the systematic risk exposure. So that beta is, we called it as the systematic risks always associated with the investment. Okay, we cannot easily remove that systematic risk. Okay, so beta I is the systematic risk for that ith company. I is the name of the company, we can say, plus RMT. Okay, so RMT is the, we can say, the market index return at the time T. Okay, so when we take the risk beta, what we know that, okay, we will get the more return when the any investor takes the risk. Okay, now when the investor takes the zero risk, he only gets the return of alpha I. That is the we can say the risk free return. Okay, that is the that return is independent of the market movement. But when he start taking the risk of beta, that is beta I, then he start getting the return as per the market conditions. Okay, That is the market index return at time t typically represent the broad market indices like the S&P 500. Okay. So what the returns is gets as per the index or the group, we can say for the different sector, different specific indices. What is the return is getting on that specific indices? That is the RMT plus we can say the EIT. So EIT is we can say a residual unsystematic return, a specific risk component assumed to be independent across the. So IIT is the we can say a residual unsystematic return. Okay, for company I at the time T. So this is the core equations of the single index model. So we can calculate the return for different companies for the different times, and those gives the maximum return, so that companies we select in our portfolio. That means we are going to invest in that company, in that organizations. Okay, so this is nothing but the single index model. So the single index model reduces the complexity. That is the we can see the comparison of one company with the another company by using the correlation, by calculating the standard deviation or covariances. Okay, so that part we minimize in the single index model, and by using this formula we only calculate the return of the ith company at the time t. Okay, and we calculate for every company that return, and which gives the maximum return, that company we select in the portfolio. So this is concept behind the single index model, and this is how the single index model reduces the mathematical complexity of the Markowitz portfolio model. So next, we know some of the economic intuitions behind the single index model components. Okay, so there are the four type of we can say risks associated with the investment. Okay, so systematic risk components, it's one of the major part. You see, these are the components of the this mathematical formula. That is, first one is the systematic risk. I already told you that beta is the systematic risk. Okay, a beta measures the how much assets I moves relative to the overall market conditions. So beta of I 1.0 indicates the assets moves lockstep with the market, while the beta greater than 1.0 suggests the higher volatility. Okay, if your beta is 1, that means the the risks associated with your investment move as per the market conditions. But it is more than 1.0, then it is we can say it is the more volatile, it is the more risky. If it is less than 1, then it is the less risky. Okay, so this is the beta. Okay, so alpha I is capture the asset specific performance that goes beyond what we can explain by the market influence. So alpha I is we can say the risk-free return what we getting into the open market. Next one is we can say the diversifiable diversifiable risk. So residual, if you see the EIT represent the specific firm specific risk that is uncorrelated across the different assets. We know that for any particular sector, the companies are different, but we know there are always the firm-specific risks is always associated with that particular company, because the management, we can say the policies of the different companies are different. Okay, so all these factors also have the effect on their financial performance. Okay, so these are the some of the systematics and the uh, diversifiable risks that is the part of the mathematical formula. Okay, so without further proceeding in the Sharpe single index model, we first need to assume some assumptions. Okay, on that assumptions, we actually then and then only we calculate the return with the help of that formula for the different company, for the different organization. So what are that? assumptions. Okay, so the elegance and the practicability of the single index model relies on the several fundamental assumptions. Okay, what are those assumptions? First assumption is, we can say, the linear relationship. Okay, so the that what that assumptions tells us that assets return maintain the linear relationship with the market index return across all the market condition, allowing for the consistent beta estimations. Okay, so that means the asset returns, okay, the return on the assets and the market index return are having the linear relationships. Okay, so next one is the single factor dominance. That's the one macroeconomical factor. Okay, macroeconomic factor like the GDP, unemployment, per capita income, national gross income. So all these are, we can say, are the interest rates in the economy. All these are the macroeconomic factors. So the one economy macroeconomic factors drive systematic risks across all the securities, capturing the primary source of correlation. That means each and every macroeconomic factors drives the systematic risks for all the companies, for all the securities. Okay, so this is the second assumption. Third assumption is, we can say, the independent residuals. Okay, so residual risk of the different assets are uncorrelated with each other, we can say, enabling the diversification benefits that makes a portfolio optimization possible. Next assumption is the homogeneous expectations. That is, all the investor shares identical expectations about the market risks and returns parameters, ensuring the consistent pricing across the market. That means all the investors having the same assumptions, same expectations from the investment that we assume, but it is not always the case, because we know that different investor has the different goals, different objectives, and that's why their expectation may be different. But here, in single index model, we considered that is the all investors have the identical expectations. Okay, so why a single index model matters? Okay, if we already have the Markowitz portfolio theory, why we need the single index model? Okay, so that is the big questions. Okay, so we can say the computational advantage of the Sharpe's single index model become the apparent when comparing the parameters requirement with the Markowitz original approach. Okay, so here we take the example. Okay, we compare the Markowitz portfolio theory with the single index model. Okay, when if we consider that there are the 100 companies, 100 organizations, okay, and the 100 stock for this 100 companies, when we need to select the best one out of which, according to the Markowitz portfolio theory, that requires the fraction n in bracket n minus 1 divided by 2 covariance estimation for the n assets. That means for 100 companies, that each company has to compare with the another company. That means when we compare the each company with the another company, we need to calculate the 4,950 covariances. Okay, and then by analyzing all these covariances, all these standard deviation, we need to select the best companies out of it. Okay, so this means that calculating the 4,950 individual covariance is the computationally intensive process. It is very hectic process. Then the mathematical calculations we need to do in the Markowitz board. So it is not possible for any investor to do such a complex and the hectic calculations. Okay. So that's why we can see the single index model is more easy, and we can say for the investment purpose. Okay, so in single index model, when we calculate the return according to the single index model, so if we consider the 100 companies, then we need only the n betas, that is the 100 betas plus one market variance parameter for the same. That means the 100, we need the 100 beta, 100 rigs, systematic rigs, and this same 100 stock portfolio requires only 101 parameter estimates. Okay, so this is how we calculate only the 100 betas and the 100 return on that companies, okay, ith companies at the time of t, and then that means that reduces only the 98% calculations. Okay, where you see how big the number, that is the 4950, and how small this number, that is the 101. Okay, so that's why the single index model is, we can say, reduces the mathematical complexity. Okay, so measuring the risk and return with the single index model, I actually we see that formula, that is the single index model, provides a comprehensively framework for quantifying both expected return and the risk, that is systematic risk is the beta. Okay, so from that model only we develop that CAPM model, that is the expected return is equal to RF plus beta in bracket RM minus RF. Okay, so that CAPM model is, we can say, the advanced version of the single index model. Okay, so in the expected return calculation, here the formula is given, that is expected return RI. R means return on the ith company is equal to RF, mean risk-free return plus alpha I. Alpha, so RF is the risk-free rate with the base return available without any, if it do not take any risks, that RF we are continuously getting. So alpha is with the asset specific return premium beyond the market driven expectations. Okay, what is when we select the different types of assets, different types of stocks, okay, different types of bonds, okay, so that asset specific return, okay, that is the alpha I, and beta is the risk, RM is the, we can say, the market return that we are getting after taking the beta risk, and RF is the risk free return. So this is the, we can say, the formula for the return according to the single index model. If you see below, here the risk formula is given to us, that is the total risk formula. The total variance combines both the risk components, that is the delta I square is equal to beta I square into delta M square plus delta EI square, where the first term represents the systematic risk and the second term represent the diversifiable risk. Okay, so that beta is, we can say, the systematic risk, and the delta E is the diversifiable risk associated with the investment. Okay. So how we construct the optimum portfolio using the single index model? What we need to do first, while implementing the sharpest single index model for the portfolio optimization, we follow these following 5 steps. That is the data collection. First, we need to gather the historical return data for candidate assets and the select an appropriated market index. Okay, first we collect the data and we specify the sector. Then parameter estimation, then we conduct the regression analysis for each asset to estimate the alpha, beta, and the residual variances. Okay, then after collections of these financial data, then we calculate the alpha and beta for each company. That is, beta is the systematic risk and alpha is the risk-free rate or risk-free return that we are getting on that investment. And third one is the risk and return calculations. Calculate the expected returns and the total variance for each assets using the single index formulas. Okay, we already see what is the formula for the expected return. So in the previous step, we already calculate the alpha and beta. Now, by putting all these value in the formula, we can calculate the expected return on for each and every company. Then portfolio matrices. After that, by calculating the expected return, then we analyze which company is giving us the maximum return. Then we compute our a portfolio, and that is we made the portfolio matrix, that is compute portfolio expected return and the risk free using the same based formula, account for both the systematic and the residual risk components. Okay. After the calculations in the formulas, okay, what we see, what the returns for each and every company, then we make the portfolio matrix. And next one is the weight optimizations. Okay. Now, how much funds we have, how much risk taking ability have, according to we use the weight for the different options. Okay. So the weight optimization in optimize the weight portfolio, way to maximize the expected return for the given level of the risk. Okay, so how much fund we have, how much risk, the financial risk or the emotional risk the investors can take in. So according to this, we construct the portfolio using the single index model. Okay, so this is how the single index model is, we can say, is the advanced version um, uh, of the Markowitz portfolio theory. Okay, that we can say minimize the drawbacks of the Markowitz portfolio theory. Okay, so I'll share one small video for your better understanding. Okay, so from this you can understand the single index model theory.
हेलो एवरीवन एंड वेलकम बैक टू द सेशन ऑन स्ट्रेटेजिक फाइनेंशियल मैनेजमेंट। दोस्तों, सीए फाइनल के इस एसएफएम क्लास में हम पोर्टफोलियो टॉपिक का कंटिन्यूएशन कर रहे हैं। हम आज की क्लास में शुरुआत करते हैं कॉन्सेप्ट नंबर 36, सिंगल इंडेक्स मॉडल बाय विलियम शार्प। दोस्तों, इस सिंगल इंडेक्स मॉडल में आप देखेंगे कि पोर्टफोलियो रिस्क को डिफाइन किया गया है एज एग्रीगेट ऑफ सिस्टमैटिक रिस्क एंड अनसिस्टमैटिक रिस्क। वैसे तो ये बात आप पहले भी जानते थे कि पोर्टफोलियो रिस्क को जब हम ब्रेकअप करें तो हमें सिस्टमैटिक रिस्क एंड अनसिस्टमैटिक रिस्क मिलता था। तो मार्कोविज मॉडल में आपने किया क्या है, सबसे पहले आपने पूरा पोर्टफोलियो रिस्क डिफाइन किया बाय टेकिंग पोर्टफोलियो वेरिएंस, फिर सिस्टमैटिक रिस्क सब्ट्रैक्ट कर दिया और जो बच गया रेसिड्यूरी रिस्क वो बन गया अनसिस्टमैटिक रिस्क। विलियम शार्प के सिंगल इंडेक्स मॉडल में ऐसा नहीं किया जाएगा। विलियम शार्प के सिंगल इंडेक्स मॉडल में पोर्टफोलियो का सिस्टमैटिक रिस्क कंप्यूट किया जाएगा और पोर्टफोलियो का अनसिस्टमैटिक रिस्क भी इंडिपेंडेंटली कंप्यूट किया जाएगा। दोनों रिस्क का जो एग्रीगेट होगा वो बनेगा पोर्टफोलियो रिस्क। तो इक्वेशन तो वही की वही रहेगी, पोर्टफोलियो रिस्क इक्वल्स टू सिस्टमैटिक रिस्क प्लस अनसिस्टमैटिक रिस्क। बट दोनों के अप्रोचेस में, यानी कि मार्कोविज मॉडल और विलियम शार्प के सिंगल इंडेक्स मॉडल में जो डिफरेंस है वो ये है कि मार्कोविज मॉडल will always first compute the total risk of the portfolio, subtract the systematic risk to arrive at the balancing figure as unsystematic risk. On the other side, as per William Sharp's single index model, independently you will compute systematic as well as unsystematic risk of the portfolio and then take the aggregate. तो ये independent calculation अनसिस्टमैटिक रिस्क का कैसे किया जाएगा सिंगल इंडेक्स मॉडल में, ये हम अभी सीखते हैं। आप स्क्रीन पर ध्यान दीजिए, मैं आपको इन इंपॉर्टेंट बातों को लिखवा दूं। So, as per William Sharp's single index model, the portfolio variance can be determined as below. Sigma p square, that is portfolio variance, will be aggregate of systematic risk and unsystematic risk. So, we know one thing how to determine systematic risk. It is sigma m square into beta of portfolio squared. तो फ्रेंड्स, सिस्टमैटिक रिस्क जैसा आपने मार्कोविज मॉडल में सीखा था, विलियम शार्प में भी वैसा ही करने का है, देयर इज नो डिफरेंस। और पोर्टफोलियो बीटा, अब वो आप मार्कोविज मॉडल अप्लाई करें या विलियम शार्प सिंगल इंडेक्स मॉडल, portfolio beta will always be the weighted average of betas of individual stocks included in the portfolio. सवाल यहां पर ये जो सिग्मा ई स्क्वायर्ड जो बता रहा है अनसिस्टमैटिक रिस्क, वो कैसे कंप्यूट किया जाएगा? सो लेट अस पे अटेंशन टू दैट. सिग्मा ई स्क्वायर्ड विल बी sigma E1 squared into W1 squared plus sigma E2 squared into W2 squared plus sigma E3 squared into W3 squared plus so on up to n number of terms. यानी कि हर एक स्टॉक के अनसिस्टमैटिक रिस्क जिसे हम स्क्वायर्ड फॉर्म में या वेरिएंस फॉर्म में रखेंगे, उसमें उस स्टॉक का स्क्वायर्ड वेट मल्टीप्लाई किया जाएगा. दैट मीन्स जैसे हम वेटेड एवरेज ले रहे हो बट इन स्क्वायर्ड फॉर्म. सो दिस इज हाउ यू विल कंप्यूट अनसिस्टमैटिक रिस्क ऑफ द पोर्टफोलियो यूजिंग विलियम शार्प्स सिंगल इंडेक्स मॉडल. अब दोस्तों ये अप्लाई कैसे करना है, व्हेन यू लुक इनटू क्वेश्चंस, ये आपको ज्यादा अच्छे से समझेगा. तो चलिए कुछ क्वेश्चंस के थ्रू इन बातों का एप्लीकेशन सीख लेते हैं. लेट अस टेक अप क्वेश्चन नंबर 71. पढ़ते हैं इस क्वेश्चन में क्या दिया हुआ है. ए हैज पोर्टफोलियो हैविंग फॉलोइंग फीचर्स. 4 सिक्योरिटीज दिख रही हैं LMNK. हमें चारों सिक्योरिटीज का बीटा दिया हुआ है ये, और रैंडम एरर दिया हुआ है स्टैंडर्ड डेविएशन फॉर्मेट में. सबसे पहले फ्रेंड्स हमने अभी थोड़ी देर पहले डिस्कस किया, अकॉर्डिंग टू विलियम शार्प दिस रैंडम एरर इंडिकेट्स द अनसिस्टमैटिक रिस्क. दोस्तों कभी भी क्वेश्चन में रैंडम एरर इंफॉर्मेशन दिया हो तो आप क्या करेंगे, यू विल ऑलवेज कंसिडर दिस एज द अनसिस्टमैटिक रिस्क पार्ट. और ये खास ध्यान देंगे कि क्वेश्चन में ये पार्ट स्टैंडर्ड डेविएशन फॉर्म में है या वेरिएंस फॉर्म में. यहां पर ये स्टैंडर्ड डेविएशन फॉर्म में है क्योंकि ये टर्म स्क्वायर्ड नहीं है. दूसरी बात ये कि ये सिग्मा ई आई, ई स्टैंड्स फॉर द एरर टर्म. ये जो आई है, आई रिप्रेजेंट्स फॉर ईच सिक्योरिटी. दैट मीन्स दिस इज द रैंडम एरर फॉर सिक्योरिटी L. This 11 is the random error for security M and the like. और सभी का वेट्स दिया हुआ है और वेट का टोटल ऑब्वियसली 1 होगा. यू आर रिक्वायर्ड टू फाइंड आउट द रिस्क ऑफ द पोर्टफोलियो इफ द स्टैंडर्ड डेविएशन ऑफ द मार्केट इंडेक्स दैट इज सिग्मा M इज 18%. फ्रेंड्स क्वेश्चन में हमें मार्कोविज मॉडल यूज करना है या विलियम शार्प्स अप्रोच यूज करना है नहीं बताया गया है, बट रैंडम एरर की हिंट इनफ है. दूसरी बात, 4 स्टॉक के लिए आपको कभी क्वेश्चन में मार्कोविज मॉडल अप्लाई नहीं करना होगा. और वैसे भी मार्कोविज मॉडल अप्लाई करने के लिए हमें बहुत सारी इंफॉर्मेशन चाहिए. L का कोरिलेशन M के साथ, L का कोरिलेशन N के साथ, L का कोरिलेशन K के साथ, फिर M का कोरिलेशन N के साथ, M का कोरिलेशन K के साथ, एंड सो मेनी कोरिलेशन इंफॉर्मेशन वी वुड वांट. इतने सारे इंफॉर्मेशन आपके पास नहीं है. देयरफॉर इट इज इम्प्लाइड कि आप यहां पर क्वेश्चन को मार्कोविज मॉडल से सॉल्व नहीं कर पाएंगे. यू विल हैव टू सॉल्व द क्वेश्चन यूजिंग विलियम शार्प्स अप्रोच. तो चलिए देखते हैं सॉल्यूशन कैसे प्रेजेंट किया जाएगा. दोस्तों सॉल्यूशन में सबसे पहले हम पोर्टफोलियो बीटा कंप्यूट करेंगे. ये इसलिए क्योंकि हमें सिस्टमैटिक रिस्क कंप्यूट करने के लिए पोर्टफोलियो बीटा की जरूरत पड़ेगी. सो बीटा ऑफ पोर्टफोलियो इज वेटेड एवरेज ऑफ बीटाज ऑफ इंडिविजुअल स्टॉक्स. हमें हर एक स्टॉक का बीटा दिया हुआ है और उसके साथ उसके वेट्स दिए हुए हैं. तो ये कोई भी नया कैलकुलेशन नहीं है आपके लिए, यू नो इट वेरी वेल. यहां पोर्टफोलियो बीटा आता है 1.295. इसके बाद डिटरमाइनिंग पोर्टफोलियो रिस्क दैट इज पोर्टफोलियो वेरिएंस यूजिंग विलियम शार्प्स मॉडल. एज पर विलियम शार्प्स सिंगल इंडेक्स मॉडल, portfolio variance can be determined as below. Portfolio variance will be aggregate of systematic risk and unsystematic risk. Variance approach से जो systematic risk आएगा, you know what it will be. It will be sigma m square into beta p squared. That is variance of market into portfolio beta squared ये पार्ट आपको दे देगा सिस्टमैटिक रिस्क, एंड प्लस सिग्मा ई स्क्वायर्ड, दिस इज द अनसिस्टमैटिक रिस्क ऑफ द एंटायर पोर्टफोलियो। तो फ्रेंड्स, ये कैलकुलेशंस जो आपके सामने अभी स्क्रीन पर है वो आप पहले लिख लीजिए, और ये मेन इक्वेशन जो है उसके बैकग्राउंड कैलकुलेशंस हम पहले कर लेंगे, and then we will arrive at the portfolio variance using William Sharp's model. All right friends, let us move ahead and make the calculations. अब ये बात आपने सीख रखी है, the given random error for each stock indicate the unsystematic risk of such stock. ये हमने already discuss किया है. As the unsystematic risk arises because of no correlation, ये भी हमने डिस्कस कर रखा है कि अनसिस्टमैटिक रिस्क मेनली अराइजेस बिकॉज ऑफ लैक ऑफ कोरिलेशन. सच अनसिस्टमैटिक रिस्क फॉर द एंटायर पोर्टफोलियो शैल बी डिटरमाइंड एज बिलो. सो अकॉर्डिंग टू विलियम शार्प, सिग्मा ई स्क्वायर ये टर्म बताता है the unsystematic risk part of the portfolio, which will be kind of weighted average of unsystematic risk of each stock. बट यहां पर ध्यान देंगे, वेटेड एवरेज डायरेक्टली कंप्यूट नहीं करना है फ्रेंड्स, हमें हर एक स्टॉक के अनसिस्टमैटिक रिस्क को स्क्वायर्ड फॉर्म में यानी कि वेरिएंस फॉर्म में लेना है, एंड देयरफॉर वेट आल्सो विल बी ऑन द स्क्वायर्ड बेसिस. सो व्हाट यू कंक्लूड इज 7, 11, 3 एंड 9 ये दिए हुए हैं इंडिविजुअल स्टॉक्स के अनसिस्टमैटिक रिस्क बेस्ड ऑन स्टैंडर्ड डेविएशन. हमने सभी का 7, 11, 3 एंड 9 सबका स्क्वायर ले रखा है, सो दैट वी हैव कन्वर्टेड दीज इनटू वेरिएंस फॉर्म. एंड यहां पर जो वेट्स हैं, हमने वेट्स का भी स्क्वायर्ड वैल्यू ले रखा है. नाउ व्हेन यू अप्लाई ऑल दिस कैलकुलेशन, व्हाट यू गेट इज 17.755, एंड नाउ you can definitely compute the portfolio variance. तो portfolio variance वाले इस इक्वेशन में जो हमें सिग्मा ई स्क्वायर चाहिए था, ये हमारे पास रेडी कैलकुलेशन होकर आ गया है. नाउ वी जस्ट हैव टू डील विद दिस फर्स्ट पार्ट. सिग्मा एम स्क्वायर इज द वेरिएंस ऑफ मार्केट. हमें क्वेश्चन में स्टैंडर्ड डेविएशन ऑफ मार्केट दिया हुआ है 18%, तो 18 का स्क्वायर लिया जाएगा यहां पर, एंड बीटा ऑफ पोर्टफोलियो जो आपने कंप्यूट कर रखा है, यू विल बी टेकिंग अगेन स्क्वायर्ड वैल्यू ऑफ दैट portfolio beta. So what you get in calculation is 18 square representing market variance, 1.295 squared is beta portfolio squared, and ये error term जो random error term है पूरे portfolio का, that is sigma e squared for the entire portfolio, जो हमने अभी यहाँ से calculate किया 17.755, same calculation 17.755. Finally ये आता है 561.11, but this is portfolio variance. We would want to determine portfolio standard deviation, which is square root of portfolio variance, which will be square root of 561.11, and that comes to 23.688%. All right friends, you would have finished writing this whole thing. Let us take up another very important question. Coming up next is question number 72. चलिए पढ़ते हैं क्या दिया है यहां पर. कंसिडर द फॉलोइंग डेटा विथ रिस्पेक्ट टू मार्केट इंडेक्स एंड टू स्टॉक्स एक्स एंड वाई. आपको क्वेश्चन के इंफॉर्मेशन में स्टैंडर्ड डेविएशन ऑफ एक्स यानी सिग्मा एक्स दिया हुआ है, सिग्मा वाई दिया हुआ है, सिग्मा एम दिया हुआ है, डब्ल्यू एक्स डब्ल्यू वाई, कोरिलेशन बिटवीन एक्स एंड वाई, कोरिलेशन बिटवीन एक्स एंड मार्केट, कोरिलेशन बिटवीन वाई एंड मार्केट. You are required to determine the following: beta of x and y, तो ये तो आप easily find कर सकते हैं. Unsystematic risk of x and y using variance approach, yes, we have sufficient information, we can do that. Portfolio variance using Markowitz model, तो portfolio variance के लिए we needed correlation between x and y. दो ही stocks हैं. If correlation between x and y is known, standard deviation of x and standard deviation of y is known, weight of x and weight of y is known, you can definitely apply Markowitz model. And for computing portfolio variance using Sharp's approach, you will need standard deviation of the market which is available, and you will need beta of portfolio पोर्टफोलियो बीटा तो आपको इजीली मिल जाएगा क्योंकि दोनों स्टॉक्स की इंडिविजुअल बीटा आपने ऑलरेडी सेकेंड पार्ट में कंप्यूट कर लिए होंगे एंड यू विल हैव टू अप्लाई पोर्टफोलियो बीटा इन स्क्वायर्ड फॉर्म एंड देयर आफ्टर यू जस्ट हैव टू मेक द नेसेसरी कैलकुलेशंस। तो फ्रेंड्स चलिए ये देख लेते हैं सॉल्यूशन कैसे प्रेजेंट किया जाएगा। सॉल्यूशन में सबसे पहले हम बीटा कैलकुलेट कर लेते हैं एक्स और वाई का। सो बीटा ऑफ एक्स विल बी सिग्मा एक्स बाय सिग्मा एम इनटू कोरिलेशन बिटवीन एक्स एंड एम। सारे इंफॉर्मेशन हमारे पास अवेलेबल हैं। 8 डिवाइडेड बाय 6 इंटू 0.8 दैट गिव्स यू 1.0667 एंड लाइकवाइज बीटा ऑफ वाई विल बी sigma y by sigma m into correlation between y and m, that will be 5 by 6 multiplied by 0.74, that comes to 0.6167. The next thing asked in the question is about unsystematic risk of x and y using variance approach. ये कुछ भी नया नहीं है आपके लिए फ्रेंड्स। तो x and y हम कॉल्यूमिनर कैलकुलेशंस प्रेजेंट करेंगे। So we'll take total risk as sigma squared, that is variance of x and y respectively. तो friends ध्यान देंगे standard deviation of x 8 है तो variance of x आएगा 8 square यानी कि 64। वैसे ही standard deviation of y 5 दिया हुआ है तो variance of y आएगा 5 squared यानी कि 25। लेस करेंगे सिस्टमैटिक रिस्क। सिस्टमैटिक रिस्क जो x का आता है दैट विल बी सिग्मा m स्क्वायर्ड इनटू बीटा x स्क्वायर्ड। सिग्मा m इज गिवन एज 6, सो 6 स्क्वायर्ड इनटू बीटा जो हमने यहां कैलकुलेट किया था 1.0667 उसका स्क्वायर्ड वैल्यू ये आता है 4.96 एंड y के लिए अगेन सेम थिंग, सो इट विल बी 6 स्क्वायर्ड इनटू 0.6167 स्क्वायर्ड ये इस तरह और ये आता है 13.69। सो टोटल रिस्क में से हमने सिस्टमैटिक रिस्क सब्ट्रैक्ट किए और जो हमें मिल जाता है एज अ बैलेंसिंग फिगर दैट इज अनसिस्टमैटिक रिस्क ऑफ एक्स एंड वाई यूजिंग वेरिएंस अप्रोच 23.04 एंड 11.31। लेट अस प्रोसीड अहेड। बीटा ऑफ पोर्टफोलियो हमें फाइंड करना है विच विल बी वेटेड एवरेज ऑफ बीटाज ऑफ एक्स एंड वाई एंड दोनों स्टॉक्स के बीटा हमें मालूम है, दोनों के वेट्स हमें मालूम है। So without any trouble we determine weighted average of these two stocks beta and we get beta of portfolio as 0.8867. इसके बाद the error term unsystematic risk of portfolio के लिए आपको मालूम है हमें क्या करना है। We have to consider unsystematic risk of x into weight of x squared, unsystematic risk of y into weight of y squared। जब ये कैलकुलेशन हम करते हैं ये दोनों स्क्वायर्ड फॉर्म में यानी वेरिएंस फॉर्म में कैलकुलेशन आपके पास ऑलरेडी थे और हमने इनके वेट्स के स्क्वायर्ड वैल्यूज को रिस्पेक्टिवली मल्टीप्लाई किया है एंड वी गेट सिग्मा ई स्क्वायर्ड दैट इज पोर्टफोलियो का अनसिस्टमैटिक रिस्क यूजिंग विलियम शार्प्स सिंगल इंडेक्स मॉडल दैट कम्स टू 10.104। ऑलराइट फ्रेंड्स लेट अस मूव अहेड। सॉल्यूशन में अब हमें आगे दोनों मॉडल्स अप्लाई करने हैं एक एक करके। तो portfolio variance that is sigma p squared, first let us find out the portfolio variance using Markowitz model and that equation, ये कितने बार आपको मैं ये भी बताऊं कि ये इक्वेशन आपको आती है। तो हमारे पास दोस्तों सारे वैल्यूज अवेलेबल है, वी जस्ट हैव टू अप्लाई द कैलकुलेशन। मुझे यहाँ पर समझाने की कोई ज़रूरत नहीं है, ये कैलकुलेशन आपको खुद को कर लेना चाहिए। एंड फाइनली व्हाट यू गेट इज सिग्मा पी स्क्वायर्ड इक्वल्स टू 38.944। हमें पोर्टफोलियो स्टैंडर्ड डेविएशन नहीं पूछा गया था, पोर्टफोलियो वेरिएंस पूछा गया था। हम यहीं पर हमारा कैलकुलेशन रोक देंगे। सेकंड कैलकुलेशन हम शार्प्स मॉडल से करेंगे। एज पर विलियम शार्प पोर्टफोलियो वेरिएंस इज एग्रीगेट ऑफ सिस्टमैटिक रिस्क एंड अनसिस्टमैटिक रिस्क। सिस्टमैटिक रिस्क एंड अनसिस्टमैटिक रिस्क बोथ विल बी डिटरमाइंड यूजिंग द वेरिएंस अप्रोच। तो यहाँ पर सिग्मा ई स्क्वायर्ड हमने ऑलरेडी कैलकुलेट कर रखा है, यानी पूरे पोर्टफोलियो का अनसिस्टमैटिक रिस्क हमने ऑलरेडी कैलकुलेट कर रखा है। ये वाला पार्ट हमें कैलकुलेट करना होगा। सिग्मा एम इज गिवन एज 6 यानी स्टैंडर्ड डेविएशन ऑफ मार्केट इज 6, विल टेक स्क्वायर्ड वैल्यू ऑफ दैट, बीटा ऑफ पोर्टफोलियो स्क्वायर्ड दैट इज 6 स्क्वायर इंटू 0.8867 स्क्वायर्ड प्लस 10.104 जो हमने पिछले वर्किंग में कैलकुलेट किया This comes to 38.4085. फ्रेंड्स, दोनों कैलकुलेशंस काफ़ी क्लोज हैं, बट दे आर स्टिल हैविंग डिफरेंस. एंड यू नो वन थिंग वेरी वेल, मैथमेटिकली it is Markowitz model that is proven by calculations. It is proven model. That means mathematical accuracy जो आपको मिलेगी that will always be with Markowitz model. But yes, विलियम शार्प के मॉडल को भी इग्नोर नहीं किया जा सकता. आपको आपके सिलेबस में दोनों ही मॉडल्स तैयार करने.
Okay, so this is all about the Sharpe's single index model. That part we finished in this sessions. Okay. So we sum up the session here. If you have any query, you can ask, or otherwise you can leave the session and join the next session. Thank you. Mohit sir, please end the session.